So this is joint work with Nicolas Trèche and Jérôme Foncel. Can you go next, Nicolas?
Yeah.
I'll say next every time. But yeah, I don't know if you heard people from Fed talk before, but whatever I say is mine. That's a usual disclaimer. Does not represent the views of the New York Fed or the federal system. Next. All right, so you might have to press next a couple of times. All right,
Yeah.
so what we try to do in this project is we're trying to better understand in practice how households manage their financial risk. And we're going to focus on two types of risk. One is portfolio risk, so the decision to invest in risky assets. And the second type of risk is insurance risk. So we're going to look at the decision to insure against risk. Next. And the reason we're interested in these two decisions is because they reflect the same but opposite risk retention trade-off. So when you invest in a risky asset, you increase your risk exposure, but when you decide to purchase insurance, you reduce your risk exposure. So at least in theory, if you have factors that promote risk taking, you can press next twice, I think, Nicolas. When you go back. When you the factors that are going to promote risk taking, they should at the same time increase your demand for risky asset and decrease your demand for insurance. Next. Now, if you look at the literature has focused, Nicolas mentioned that earlier, the literature focused mostly on a portfolio decision. There is little, especially on the empirical side, on insurance demand, the determinants of insurance demand. And there is almost nothing on the joint decision to insure and to invest in risky assets. So what we're going to try to do in this paper is look at this joint decision, explore at the household level the joint decision to insure and invest in risky assets. And in particular, and we're going to try to identify whether there are joint determinants to the two decisions, and as well as joint frictions to the two decisions. That's one thing we're going to do. And in particular, we're going to focus on one aspect, which is the effect of wealth. So both from the theory and both also from empirical studies, we know that as people become wealthier, they tend to be less risk averse. And as a result, we know also that from the empirical literature, they tend to invest more in risky assets. And in theory, they should also purchase less insurance. So we're going to try to test whether indeed, as people become wealthier, there is this opposite effect of wealth on portfolio and insurance coverage decision. Right? We're going to just go back. We're going to do so by using micro level data, very detailed micro level data that we get from a survey in the US. Next. So in case I don't have time to go until the end, I'm just going to give you a preview of the results. First, we're going to find that indeed there are joint determinants of decision, of portfolio and insurance decision, and that it is consistent with theory. So theory is going to have a predictive power. We're also going to find a set of frictions that are common to the two decisions. And we are going to identify that to find that insurance and risky decision both increase with wealth. So I guess that's not going to surprise the practitioners that are listening right now. But from a theory perspective, this is a bit of a puzzle. In theory, as I mentioned earlier, if you become wealthier, you should at the same time, under standard assumption, you should at the same time purchase more risky investment and insure less. So what we're going to try to do in the second part of the paper is to try to rationalize what we call this insurance portfolio puzzle. We're going to try to do it in two ways. Can you press next? First is by trying to expand conventional theory. And secondly, we're going to try to also look at various behavioral theories. Next. And, as you will see so far, we've not been able to explain this puzzle in a way that's very satisfying. All right, the empirical approach, you can press next a bunch of time. I'm not going to go into the details. Essentially, what we're going to do empirically is estimate a joint model of insurance and investment risky asset. It looks like a trivial model, but actually it's not that trivial to estimate. But I'm not going to get in the detail of that. So we can move to the next slide, Nicolas. Let me talk about the data. So the data come from the survey of consumer expectation. Next. This is a survey that is produced by the New York Fed since 2013. There are a number of key features. It's a monthly survey. It's an internet-based survey. Every month we have roughly 1,300 respondents, and it's also nationally representative of the population of household heads. For this study, we're gonna use 4 waves. The first one was in 2015, the second one in 2016. We conducted a survey just in February in February, and we are about to put a survey in the field, in the next couple of days. And I want to take this opportunity to thank SCORE because they are helping us finance this survey. So thank you very much for your help in financing this research. Nicola, can you press 12? Next. Okay, so one of the nice thing, so in this study, when we're going to look at insurance decision, we're going to focus on auto decision and homeowner insurance. There are a couple of reasons why we focus on this type of insurance. One is that because the consequences are mostly financial, which is what we're interested in, to stay as close as possible to standard theory. And the other one is that because everyone in the US, or essentially everyone in the US, have a car, so there is no selection effect. Now, the beauty about doing surveys is that you can ask people very, very detailed questions, and in particular about their insurance contract. So, we ask people in our surveys to go and get their insurance contract and their auto insurance contract, and we ask them, very detailed questions about their liability coverage, all sorts of coverage, personal injury, collision coverage, whether they have rental coverage, towing, roadside assistance, and so on. Next. We can also elicit a lot of very interesting variables about the respondent, the individuals. Variables are usually difficult to observe. So, for instance, we have the current value of the vehicle that is insured. We can also ask about objective risk. We have a measure of objective risk faced by the car owner. We ask about the damage that were incurred over the past 2 years. We also have a measure of subjective risk, which is a unique measure that we have not found in the literature, where we ask people about the damage the sum of the damage they expect to incur over the next 2 years. Same thing, you can press next. Same thing for the decision to invest in risky assets. We can ask about subjective expectations and their knowledge about their own debts and savings. Next. In terms of individual characteristics, we ask about the usual characteristics that you get usually. So age, education, race, marital status, employment status, whether you have kids, and so on. But we can also elicit some very interesting behavioral variables. So, for instance, we have a measure of the respondent financial literacy. We have a measure of credit worthiness of the respondent. We have a measure, we know the extent to which the respondent is liquidity constrained, and we can also elicit a measure of risk attitude. Nicola, next. All right, I'm just showing you these tables to tell you that we actually did estimate these models and we actually have results, but I'm not going to comment on the table. So if you can press next, Nicola. So let me just give you a flavor of the main result we find in the paper. So first we find, as I said, we find some joint determinant. So for instance, we find that subjective expectations have an impact for both investment decision and the decision to insure, and that the effect is consistent with what theory predicts. So for instance, if you expect that you're going to incur more damages on your car, you are going to purchase more insurance. Same thing, if you expect that the stock market is going to increase more over the next year, you tend to invest more in risky assets. So this is consistent with theory. We also find the effect of risk attitude to be consistent with theory. People that are more risk averse are going to invest less in risky assets and insure more. So this is reassuring, this is consistent with the idea that both investment in risky assets and portfolio decisions are both sides of the same coin. And this is also a sign that standard theory has predictive power. We also find an effect of age in the sense that people that are older are going to insure more and invest less in risky assets. We also find a set of frictions. some of these frictions are known for portfolio decisions, but they are brand new in the insurance literature. So we find, for instance, that people that are liquidity constrained at the same time invest less in risky asset and insure less. Same thing for people with low numeracy or low financial literacy, people with lower degree of information or knowledge about both insurance and investment portfolio decisions, and people with low education. These people tend to invest less in risky assets and also insure less. Next. So we find also this wealth effect that I mentioned, in the sense that we find that insurance coverage and risky asset holdings both are positively correlated with wealth. So as I said, this is not a surprise for practitioner, but this is a puzzle for theory. This is inconsistent, at least with standard theory, that see both decisions as two sides of the same coin. We also find an interesting behavioral asymmetry that drive partially the puzzle, which is that the poor are more likely to underinvest. This is a result that's already well known in the literature, that people with lower income or lower wealth tend to invest less in the stock market. This is a stock market participation. We also find that the rich are more likely to overinsure. So that's kind of an interesting result, because it contradicts both the fact, the belief that some people have that the poor tend to underinsure or not insured enough, and that the rich make less less mistakes in terms when they make financial decisions. Can you press next, Nicolas? And the other thing that we find is that this, we're going to call it mistakes in parentheses, this tendency to overinsure by the rich has high financial consequences. We estimate it's more like a back of the envelope calculation, but we estimate that this overinsurance by the wealthy, the cost of this overinsurance by the wealthy exceed $14 billion per year in the US. I see there is a question by Christian, so let me read it. What's the difference between a financial asset and an insurance contract?
Well, Olivier, that's for the discussion at the end. I mean,
okay, very good, very good. All right, so one thing we do in the paper is, we do a bunch of robustness check to make sure that the result that we find are robust. So I'm not going to go through all of them, but we look at alternative definition of key variables. So wealth, insurance, also, investment in risky assets. We look at restricted sample. We look at interaction effects. So we recognize the fact that wealthy people tend to have cars, for instance, that are of higher value. We look at the possibility of wealth endogeneity. That's more for the econometrician in the audience. We look at other form of insurance. So we look at car insurance, but we look also at homeowner insurance. And, it's, Nicolas was mentioning, we look at extended warranties. We look at a different country and a different type of data. So we have Banque Assurance data from France. Next, Nicolas. And the bottom line of this robustness check is that they confirm the set of determinants and frictions that we found, that they are essentially the same across all these robustness check, and they also strongly confirm the fact that both insurance and risky investment both increase with wealth. So the next question we ask is, to what extent can we reconcile this puzzle, this portfolio insurance puzzle? How can we reconcile it with theory? Next. So the first thing we're going to do is look at a host of, we're going to try to expand standard theories, the standard theory, the standard model, or the canonical models, look at separate decisions. Yeah.
Yeah, sorry, the clarification question to be sure we are on the same line. When you say insurance demand increase with wealth, what do you mean exactly? Do you measure insurance demand by premium expenditure? Or,
no.
I mean, but the wealthier people have bigger car and therefore pay larger premium, but maybe have a smaller level,
so we
level
control
of coverage.
So we control for the premium, and we look at the coverage that you take. So as I mentioned, we have this list of different coverage that you can have, so liability coverage and so on, and we look at the amount of coverage that you take. So it's really the amount of coverage that's taken, controlling for the premium paid.
Okay, thanks.
Okay. Okay. So we try to expand the theory in the standard theory in many dimensions. So we look at, what happened when the decisions are made simultaneously. We look at the effect of background risk. We look at what happened when there are wealth dependent losses or wealth dependent probabilities. What I mean by this is, maybe the chances of a BMW to be stolen is higher than the chances of I don't know what a small Renault is these days, but like a Clio or something like this. Um, we look at the impact of considering liability insurance, which is also some sort of a wealth-dependent loss. We look at the impact of liquidity constraint. We look at the effect of adverse selection, moral hazard, and we also look at supply side effects. So in particular, let me say a word about this. We look at two things. One, we look at the possibility that there is price discrimination based on wealth. So, that the wealthy would pay different prices for their insurance. And we also look at the incentives of the insurers, which may be different for the rich and the poor. Maybe the insurer is going to be willing to expend more energy or effort to sell more insurance to the wealthy. So we try to look at this effect. We cannot completely exclude that, so we find no evidence of price discrimination based on wealth, but we cannot completely exclude the possibility that, especially given the incentive of insurance agents, that they expend more energy to sell more insurance to the wealthy. We cannot completely exclude this possibility, but we don't think, especially for auto insurance where the margins are pretty small, we don't think it can explain entirely the puzzle. But we are exploring this possibility a little more in a new survey that we're conducting. Next, Nicolas. So we're also looking at behavioral theory. So same thing, we looked at a host. I mean, we've been working on this project for almost 20 years now. So we've been really scratching our minds to try to explain this puzzle. We've been talking to a lot of people. So we looked at a lot of different theories. We looked at prospect theory that Nicolas mentioned earlier. We looked at the possibility of risk misperception that could be different for the rich and the poor. We'll look at the effect of rational inattention. We'll look at information frictions. Participation costs, which could be different for the rich and the poor. We look at context-dependent preferences, like Nicolas mentioned that as well. That could be different for insurance decision and for portfolio decisions. We'll look at non-monetary benefits that have been mentioned. So, in particular, this notion of peace of mind that, you may want to get insured for peace of mind, and possibly the rich would have a bigger peace of mind from being fully insured than the poor. So we asked some question about that in a survey, and we find some sense that people care about peace of mind, but we have no evidence that the rich care more about peace of mind than the poor. And we also look at regret avoidance, and although at this stage we don't have convincing proof that regret avoidance could explain the puzzle, some of the results that we have suggest that it could be a potential explanation. What we find is that when we ask the respondents about, what they think about when they insure, the rich or the wealthy are more likely to say that when they buy insurance, they think about the regret they may feel if they incur some damage and they don't have enough insurance. So it could be an explanation as to why the rich may want to buy more insurance, because they may feel some regret if they end up having some damages and did not have enough insurance. So we're at this stage, we're not entirely sure whether this explanation can explain the puzzle, but it's one of the possible explanations that we're exploring more these days. Nicolas, can you press next? So as I said, we are conducting 2 new surveys, and we are exploring additional theories. One that is not entirely different than regret, which is a preference that people may have for positively skewed lotteries. We're looking at the possible impact of consumer consumption commitments. We're looking more closely at the effect of loss aversion. We're looking at a very simple explanation, which would be mental accounting. So the idea that people have specific budget for insurance, for investing in risky assets, and that this budget, so the money is not fungible across these budgets. and that this budget would increase with wealth. So that could be a very simple explanation for the puzzle. We're looking at the possibility of we're looking at salience theory as well, and disappointment aversion, which is not also entirely different from regret theory. And we're also looking more at regret theory. Nicolas, can you go next? Okay. So conclusion. So we conducted, a series of surveys. We look at the joint decision to insure and to invest in risky assets. The reassuring thing is that we find a set of joint determinants and frictions, which are, especially the determinants are consistent with standard theory. So we find evidence consistent with the idea that both decisions are two sides of the same coin. However, we identified this insurance portfolio puzzle, which is a demand for both risky assets and insurance increase with wealth. We find that this puzzle is statistically robust and it's also economically relevant. We find that the puzzle is driven in part by this very specific behavioral pattern, which is new, or at least part of it is new, which is that the poor tend to invest too conservatively. That's well known in the literature, but that the rich tend to overinsure. And so far, as I said, we have failed to explain the puzzle with either standard or behavioral theory. And Nicolas, can you press next? And we're open to suggestions. If you have any ideas, and I'm talking in part to the practitioners, if you have any ideas as to why it's the case that wealthier people tend to insure more, we welcome your suggestions. We still may have time to put some questions in our survey to test this hypothesis.
So thank you, Olivier, and thank you. So I don't know if we have time to develop new ideas or suggestions, but time for questions for sure.
Or you can send me emails afterwards, or you can send Nicolas emails.
Christian has a first question.
Oh yeah, very quickly maybe. So yes, there are three financial decisions typically in for household: portfolio choice, insurance, and lottery decision. I mean, and so these three decisions are very similar. Just it's a question of framing. With the lottery choice and insurance choice differing from typical portfolio choice and you mentioned that, Olivier, and I like it very much, the skewness of the lotteries and insurance choice is the clear difference compared to standard portfolio choice, which are not necessarily normal Gaussian, I mean, but not far from Gaussian. So yeah, probably one source of the explanation between the quality, I mean, the characteristics of those choices and the different with portfolio choice come from the skewness, the third moment of the distribution.
So there was no question, right? That was a comment.
Yes, the question was unclear. So I have
you
a
are
question.
Perfectly right. That's the comment.
Okay.
No, Christian, you had a question on the chat, so maybe I can answer a question for you if you want, because I had the same question, in fact. So how do you disentangle the traditional financial products from insurance products? So in terms of your
so
data.
we define portfolio products. So it's the amount of wealth. So it's either the amount or the share of the wealth that is invested in. So we have different definitions. So first, it's either the amount or the share of wealth that is invested in the stock market. That's one definition we have. Another definition we have is either the amount or the share in the stock market plus, the amount invested in private investments or businesses, for instance. And also we have a definition in which we include housing risk. So we include the amount that you invest in your house. So that's the definition of risky assets. And for insurance, as I said, it's very simple. It's insurance coverage either we look at auto insurance or homeowner insurance. That's what we look at.
No, but Olivier, I think the question was more from a conceptual point of view, because in a sense, it's only a matter of correlation in a sense between the different types of risks, and maybe as Christian said, a matter of distribution. But you know, if you invest a lot in negatively correlated assets, assets negatively correlated with your other portfolio, you are in fact hedging. So you are investing in financial markets for hedging reasons. So it's
no, that's right. So I mean, to a great extent, you can, I mean, so that's something we look at, but to a great extent, you can assume that there is little correlation between, you know, car insurance and investment in the stock market. So that's not necessarily something we worry about. But yeah, I mean, you know, that's something that we can, that we look at. That we've looked at.
Do you have a measure of human capital? You know, like
yeah, that's something we have looked at as well. So, and in the new survey, we also try to measure risk with respect to human capital. So, you know, the probability of losing your job, the probability of your income decreasing over the next couple of years, you know, your household income decreasing over the next couple of years. So I know there are studies that are doing this type of things. I don't exactly understand how that would explain the puzzle. I don't want to speak for Nicolas, but I think that's the same. I mean, we're not, I mean, I know there are some studies that have been looking at this lately. We're not entirely sure how that would explain the puzzle, but we had some question related to that.
Okay, so we will, oops, sorry.
I see Astrid.
Yeah, we will close the Q&A session with Astrid again.
You always cut me off.
Aisling also have a question.
So
no,
I like, you know, it's a repetition of a good strategy, so good.
So can I ask my question?
Yes,
Yeah,
go ahead.
Sure.
Okay. No, I was wondering, because you were talking about mental accounting, and I was just wondering to which degree this might be even consciously done by insurance companies or banks that sell insurance products, because, you know, sometimes you hear these kind of advice that says, like, put 20% of your budget into this or that, or, you know, and so this might, if this is seen as an advice to everybody, to the rich and the poor, then obviously the rich have a much bigger budget for certain products, right? For insurance, for example. So I'm just wondering, do you have any evidence if this is used in the marketing of the insurance products? You know, that they say, you know, don't spend more than 10% of your overall budget on insurance products or something like that. I don't know.
So insurance, not as much, although, you know, I think on average, you know, the premium you pay is roughly around 10% of the value of the good that you insure. But you know, I've not seen that in advertisement. In terms of investment in risky assets, there are a lot of advice, you know, rule of thumb. It's, you know, your age minus something, you know, that's the
exactly.
proportion
So
of
that's
risky
what I
asset
know.
that you should have. Yeah, so we looked at that. You know, it doesn't sound like, I mean, you know, it's at least for risky assets, it's not related to wealth, it's more related to age. So we looked at that. We also put some question in this survey to know the extent to which people are aware that they are investing too much, or sorry, that they are insuring too much. So, and there is does that answer your question, Astrid?
Yeah, a bit. I mean, I'm just curious to know.
Yeah, I'm not aware in the US of any of advice related to insurance where they say, you know, you need to set a budget for yourself. I mean, I've not seen it advertised. I mean, there are a lot of advertisement for insurance in the US, but not, I've not seen any that tell you need to set a specific budget. Okay. And regarding the question about over insurance from Aisling, I'm going to say over insurance, quote unquote. We have different measures. One, for instance, is the extent to which you take coverage on your house that exceed the value of your house. So you have a house that's worth $500,000. and you take coverage for $700,000 on your house. That we would call overinsurance. So we have different measures like this. Also, whether you tend to purchase roadside assistance, which is, these kinds of add-on that are known to be not necessary and to cost a lot. And so we have a bunch of, measures like this. And we define this measure of overinsurance. It may not be perfect, but we have a bunch of measures. We use an index based on some of these variables.
Okay, great. So we have to move forward. Our next, thank you, Olivier, for your talk and for the answers. So
thank you, Nicolas, for
yeah.
playing with the slides. Thanks.
So our next speaker is Philippe Dedonder, who is going to speak about state-dependent preferences. He is able to share his screen, so
yeah.
The floor is yours.
Thank you. So I guess you can hear me and see the screen. So Nicolas asked me to present some recent work I've been doing on behavioral long-term care insurance. So let me start with the definition just to make sure we are on the same page. So long-term care, or LTC, is the care for typically older people who need some assistance in their daily living activities, such as bathing, dressing, eating. You have the whole list there. And so usually this kind of care is over a prolonged period of time. So it's not just for 2 weeks, it's for a couple of years. And it's especially for elderly people. And so in this literature, there is also an insurance puzzle, which is basically, why do we see so little insurance, and especially private insurance? Because if you look at the kind of risk that dependency, another name for LTC, represents, basically the probability of being dependent is something which is quite large. It's something like in between 1/3 and 50% for most people. And the kind of expenses that are not covered by any kind of public or social insurance is usually very large. So it seems on the face of it to be a very, very good case to get insured, but you don't see much insurance in practice. Now, there are many, many reasons, of course, to this puzzle. There are demand side reasons, supply side reasons, and people at TSC have been working on this for a long time. Since more than 10 years ago, with a few colleagues from TSC, we wrote a TSC note with with a literature review at that time about the many reasons behind this insurance puzzle. But today, of course, I will only focus on the behavioral aspects. And so I will spend most of my time talking about misperceptions of the risk. And at the end of the talk, I will also briefly mention some current work I've been doing on state-dependent preferences. So for misperception of risk, of course, the basic idea is pretty simple. If the agents, they underestimate their own risk, this would decrease their willingness to pay for this kind of insurance. And so it would probably kind of explain at least a part of the puzzle. So the results I'm going to present are based on 2 papers with the same set of Canadian co-authors. And basically the first paper focuses exclusively on the risk misperception. And the second paper basically puts these misperceptions together with many, many other stuff, other kind of informational frictions, adverse selection, literacy, all the things that we had, and put this in a more state-of-the-art demand model for insurance. But of course, we get, in terms of risk perception, we get the same kind of results in both papers. So if you're interested in the risk of dependency, there are basically 2 dimensions. The first one is longevity, because these dependency occurs at very old ages, 75, 80 years and above, usually. So there is a longevity component in that. And there is also a component which is pure disability at old age. If you look at the literature on the misperceptions, there is quite a literature on the first thing, on longevity, with papers showing, for example, that on average, people tend to underestimate their survival probability at the age of 70, but they would overestimate the same probability to be alive for ages which are above 70, 75, and 80. But you don't, at least we haven't found any comparable literature for misperceptions on the disability risk at old age. So there is a paper by the Costa Fonts showing that people on average, they show some aggregate optimism, in the sense that if you ask to a bunch of people what is the probability that you will be disabled at some point, and what is the probability that you think on average people have to be disabled, usually they think that their own probability of being disabled is much smaller around 20% compared to the average probability in the economy. So on aggregate, on average, people seem to be quite optimistic. But this is something, this is basically all that we know. It's just one of or two studies, and we wanted to go further. So our contribution is fourfold. So we provide evidence for Canada. We'll explain in the next slides. First thing, we have 3 different measures. One measure for longevity. We ask people what is the probability that you think you will live to the age of 80. And then we have 2 measures for dependency. The first one is simply what is the probability that you will be dependent at some point in your life. And the second one is more the probability of entering a nursing home or probability of needing some formal care. Because a big thing in this literature is the home care versus formal care. But I won't have time in 20 minutes to talk about this difference. So I will stick with longevity and the probability to be dependent. So for both measures, basically, we have a subjective measure, the answer that people give to the question. We also construct an objective measure. I will explain how in a few slides, which is supposed to reflect as accurately as possible their real probability of being dependent and probability of living a long life. And of course, we compare the two and we see on the individual basis whether people tend to be optimistic, pessimistic. And finally, what we also do is relate the different dimensions to see whether someone who is optimistic for longevity, is he also optimistic for dependency or not? Are these things correlated or not? And finally, the most important part of the paper is, of course, the link between this misperception and the demand for insurance. So can these misperceptions explain a large part of the lack of insurance? So to answer all this, we ran an online panel survey with 2,000 Canadians aged 50 to 70. We asked them a bunch of usual questions about their socioeconomic characteristics. We asked them whether they did purchase or not some insurance and the reason why they did so or did not do so. And we also asked them the type of care that they would prefer to receive, formal versus informal. As I said, we have also asked them questions about their subjective assessment of the different risks. And the last part of the survey is the most interesting and original. That's a stated preference experiment where we, based on their answer, we compute their probability of becoming dependent. And then based on this probability, we offer them some hypothetical insurance product that are more or less actually fair. And we see whether they have a high or low willingness to buy such products. And this is something we want to relate, of course, to their so-called misperceptions. So once we get all these data, what we do is match all individual answers with the health microsimulation model called COMPASS that was devised by my co-authors. And this model estimates individual lifetime exposure to the risk of disability, nursing home entry, and longevity. So it is really based on this microsimulation model that for each individual, we compute some kind of objective measure. And for lack of a better way to assess their real probability of being dependent, we consider that this is somehow the truth. And we consider that any deviation from the result that is given by COMPASS is somehow either a kind of misperception, optimism, or pessimism. Finally, we studied the individual determinants of these misperceptions, and more importantly, we relate them. We try to see how they could explain or not their intentions to buy the insurance product that we propose to them at the end of the survey. So the results pretty quickly. First, in terms of the misperceptions per se. So if you just look at averages, basically there is not a lot of misperception in the following sense. If you compare the average probability of living to 80 years old, if you compare it if you compare what the model is telling us, what the COMPASS model is telling us, and if you compare it with the average answer of the recipients, the difference is quite small. It's less than 5 percentage points. It's bigger. It's twice as big if you look at a dependency. The difference between the two is something more like 9%. But actually, yeah.
Philippe, the misperception goes in which direction?
That's my second point. That's my second point.
Okay,
so exactly what I give here is the absolute value of the difference, but that's the first thing. You see, they are not very far from reality on average. Now, in which side do they err? Well, it depends on the risk. So on average, they get optimistic for dependency So they underestimate their probability of becoming dependent, and they're optimistic for survival probability. So they tend to overestimate their probability. But if you look at the third risk, which is a nursing home entry risk, then they are pessimistic. They tend to overestimate their risk of needing a nursing home in reality. So this tells you already something, but it's only averages. So we are not especially interested in averages. We are interested in the individual answers. And so if we look at this, I will go straight to this histogram. So for the histogram on the horizontal axis, what you get is the difference between the objective and the subjective probability of becoming dependent. Okay, so if you get something which is positive, it's that you are basically optimistic because you think that your own stated probability is smaller than the real probability. And you have in yellow what we call the objective measure, and you have in blue-gray the subjective measure. So first thing that you see is that the subjective measures are all over the place. Okay, our model predicts for most of the people a probability between 40 and 75%, while for people they report really the whole 0 to 100%. Of course, you can say that it's because our model is based on a limited number of individual characteristics, so it cannot generate the whole heterogeneity among the population. That's certainly true. On the other hand, it's difficult to believe that there are such large chunks of the population that would have a probability of being dependent close to 0 or a probability that would be very close to 100%, which is what people tell us. And so you see here the problem of looking only at averages, because if you average out the yellow bars and the blue-gray bars, the difference between the two is quite small. If you look at the whole distribution, you see that the distribution is much more all over the place for the subjective compared to the objective ones. But that's only part of the answer, because this doesn't relate for each individual, the subjective and the objective measures. So this is what we do here. So on the histogram on the right-hand side, you have for each individual, you have basically the distribution of the difference between the subjective and the objective probability of becoming dependent. And basically, you see that the distribution is kind of has three modes. So in the center, you have quite a large mode of people whose answer is quite close to the answer that is given by our COMPASS model. So they seem to have a very good idea about their own probability of becoming dependent. But you also have two other modes. You have one mode of people who think that their probability is 50 percentage points lower than what it is in reality. So these are people who are extremely optimistic, but you also have a bunch of people who are very, very optimistic and think that their probability is much, much higher. If you look at the distribution function on the left-hand side, you see that roughly 60% of the population is basically optimistic compared to for the dependency risk. But if you look closely at the distribution, you see that the distribution is really all over the place. If you do this similarly for the risk of longevity, so pi is the probability of living, of being alive at 80. So here it's objective minus, no, it's subjective minus objective. So if you have a positive number here, it means that you are very, you are pessimistic. You think that your probability is higher than it really is, at least what we think it really is. You see that the distribution is basically more bell-shaped and closer to 0. And we also get that 60% of the population is optimistic. 40% think that their probability is lower than what it is in reality. 60% think that it's higher. So there is a lot of heterogeneity, and yeah, we think that there is a lot of there is not a lot of good correlation between the objective and the subjective measures. So then we look at cross correlations. So we look across different risk. And so I will just talk about the third panel here. We can basically the panel A and B. I mean, the three panels do the same thing in the sense that they compare. So the pi dimension, which is the longevity dimension, and the PADL dimension, which is the probability of becoming dependent. And so on panel A, we compare the two for the objective risk. On panel B, we compared the two for the subjective risk. That's why it looks more than like a grid, because nobody tells us that their risk is exactly 42.85%, of course. So it looks more like a grid. But what and we can talk about this in the Q&A if you want, but I would like to spend a bit more time on the bottom panel, panel C, which is basically the correlation between the mistakes that they make on the two dimensions. So on the horizontal axis, you have their degree of optimism for dependency. And on the vertical axis, you have their degree of optimism or pessimism for the longevity. And so 1 point is one observation, and you see that really people are everywhere. So if you count the percentage of people in the 4 quadrants, you see that the 4 quadrants are populated. Some are more populated than others, but basically there are people everywhere. And if you look at the correlation, or here the regression line, you see that the slope of the regression line is very close to 0. So basically knowing that somebody is pessimistic in one dimension doesn't tell you much, if at all, about what these people think about the other dimension. Okay, so we have many more results, but of course I don't have time to cover everything. We then look at the correlates of the misperceptions, and here I don't think I have very interesting things to report, because we don't have a good model to explain why people have these misperceptions, and especially the results of the regressions that we have on the free risk are quite different. I mean, there are some things that seem to explain part of the misperception in one dimension, but not in the other one. So we are not very confident that we did a good job at explaining the misperceptions. What is more interesting, and maybe that's, if you have to remember only one slide, that's the one from this presentation, it's the link between these misperceptions and the actual purchases of insurance, or the intention to purchase insurance in the stated preference experiment at the end. So we start with quite good news, because we find that misperceptions are significantly and positively correlated with intentions to buy insurance. So people who are, let's say, optimistic tend to have a lower willingness to pay for insurance, and vice versa. So this is kind of reassuring in terms of the model we have in mind. On the other hand, the other reasons are not very good in terms of explaining the puzzle, because we find that these misperceptions cannot explain why the take-up of LTC insurance is so low at the aggregate level. And this is for 2 reasons. The first one is that the coefficients are quite small. Okay, so misperceptions have an impact, but the impact is not very large. So for instance, a 10 percentage point increase in the misperception of the dependency risk increases demand for insurance by only 1 percentage point. So it's an effect which is quite small. And moreover, well, you have seen in the description of the misperceptions that they do not all go in the same direction. There are many people who are overly optimistic, but there are also many people who are pessimistic. And so if you correct for all the misperceptions in all the 3 dimensions simultaneously, then that would increase the take-up of insurance by at most 1 percentage point. So there is an effect, we can measure it, it's significant, but it's very, very small compared to the real puzzle, which, I mean, the real difference between the proportion of people who do buy insurance and the proportion of people who should buy insurance, if they were perfectly rational. And this is by and large confirmed in the much more sophisticated demand that we have for the AEJ paper, where we put not only misperception, but adverse selection, but many other things. And this is confirmed. And by the way, in this paper, we show that there is very, very little evidence of adverse selection, which is another reason to think that the information that people have about their own risk is not much better than the insurance that the provider of the insurance can, the information that the provider of insurance can have about the risk of the people. So that's it for the misperception. I will say a few quick words about the state-dependent preferences. It's a bit further away from a pure behavioral thing, but I think it's related, and it's something we are currently working on. And so since Nicolas told me to talk about current research, I think this is a place here. So we have discovered that most of the theoretical literature that studies this kind of puzzle uses the same kind of model, where dependency is modeled as a pure monetary shock, a kind of ransom. And this shock is not affecting preferences. And the consequence, of course, is that you have a higher marginal utility in the state of the world, and you want to insure against this risk. But if you compare this with the more empirical or the health economics literature, this literature starting in the end of the 1960s has suggested that the preferences, they do indeed change when dependency strikes. So with Marie-Louise Leroux from Montreal, we basically build a theoretical model where when you are in a state of dependency, this changes your preferences. And we put a lot of importance in this model on the composition of the good that you consume, on your consumption basket, because your consumption basket is typically not the same when you are dependent and when you are not. And so the story is the following. We distinguish two parts in consumption. There is the daily life consumption, and there is also long-term care expenditures. So of course, if you are not dependent, you only care about daily life consumption. If you become dependent, you suddenly face with these expenditures. So of course, you have these expenditures have to be paid somehow. So it increases your need to transfer income into that state of the world. But on the other hand, for the rest of your income, what is not devoted to these expenditures, the daily life consumption, we make the assumption, which is something that you find in the empirical literature, that the marginal utility of this consumption is lower when you are dependent. So you think about old age and kind of things that all old elderly people, especially dependent, can consume in terms of traveling, attending cultural events, going to restaurants, physical activities. I hope you remember those kinds of activities that basically we forgot for the last year or so, but okay. Look at your memory. This kind of activities, basically, the point is made and it's measured in the literature that the marginal utility of these activities becomes lower when people become dependent. And so basically you have a trade-off. When you become dependent, you may need more money to cover the health services components and the long-term care expenditure component of your consumption, but for daily life, the marginal utility is smaller. And so what we get in the model, I'm seeing what I'm doing with time. What we get in the model is first that with this kind of model, nobody wants to fully insure themselves, even if you provide them with actually fair insurance. No one will want to fully insure, and at least some people will not buy any insurance at all. A second result, which is maybe more interesting for insurance providers, is that at equilibrium, the transfer that you receive from the insurer will only cover a fraction of your long-term care expenses. So I should say that in the model, you choose both the long-term care expenses and you choose the amount of insurance that you want. And so I think this sheds some light on different kinds of contracts that are observed worldwide. So I will talk about the situation I know a little bit better, which is Canada versus the US. So in Canada, the long-term care insurance contracts that you observe, they just pay you a transfer in case you are dependent. But the transfer is not dependent on, it's not conditional. You can on anything. You can do whatever you want. You just have to go to the doctor to prove to the insurer that you are technically dependent and you receive a sum of money. And with this sum of money, you do whatever you want. In the US, it's mostly cost reimbursement contracts, where if you are dependent, the insurer will reimburse you part of the totality of your long-term care expenses. But in our model, basically the difference is of no avail. The constraint that you have to use this money to cover your dependency expenses is not binding at the equilibrium, because anyway, you would like to underinsure and to receive a transfer which is lower than the amount of expenses. And then for the rest of the model, basically, we try very hard to understand how the demand for insurance varies with income in this setting. And we try especially hard to obtain testable implications of our model to try to disentangle certain effects that exist in the literature. And I think we will have to work even harder, because actually we received the referee reports early this morning. And so we have a revision, and basically what the referees want to know more about is how we can fine-tune these testable implications. And so to finish this, there will be an empirical component to this thing, because with Marie-Louise Leroux and other Canadian co-authors, basically we have run a survey in the last months, still with Canadians, where we really try to assess the state dependency of their preferences when they are dependent, when they are not. We put a lot of emphasis also on the difference between home care and nursing homes. And finally, of course, it was done last year, so we had to add a few questions about COVID and COVID perceptions and see how these perceptions would affect the choice of care type by the people and whether it would affect their preferences for one type of institutions versus the other and their preferences when for insurance, basically. So this is something we have been working on. We have the data and we are currently working on this. So maybe in a few months, I will be able to tell you more about this. So thanks a lot for your attention.
Thanks a lot, Philippe. So we have a question by Christian. So maybe other questions, but not on the chat.
Thank you, Philippe, and congratulations for your revision. I have an hypothesis for you. I mean, my hypothesis is as follows. People underestimate the impact of individual characteristics on longevity or on the probability of becoming dependent. I mean, the hypothesis is, let me assume those risks are just chance. They are not affected by individual characteristics. So that would imply that low-risk people will be pessimistic because they will assume there are the middle risk rather than the low risk, and symmetrically for the high risk, they will be optimistic. Could that explain some of your result or not?
I don't think so, and I'm going back to this thing here. So you want to compare, so do I have this? It's possible that I don't have, no, I haven't kept it, I'm sorry. We have graphs where we put on the vertical axis, so for one risk, the probability of dependency, we compare their stated risk with the objective risk. And so if you are right, we should basically see some curve in between the two, I mean, some relationship. So you think that people, how does it work? That people with a low risk think that actually their risk will be higher. So it would be some kind of negative correlation between the two, if I understand correctly. And this is not something that we observe in reality. The correlation that we observe is close to zero, actually.
Okay.
So that's a good idea, but it doesn't seem to be working.
I try to find some logic to what you get. In fact, it's very rich, so I didn't follow everything. But yeah, my natural conjecture is that, and that's from looking from the debate on pension reform in France. So people underestimate the heterogeneity of risk in the population when we talk about that. But yeah.
Yeah, but really, when we started exploiting the result, we started with the averages, and then we really were surprised by this kind of wisdom of the crowds that, I mean, especially for dependency, that people seem to have not, on average, not a bad estimate of the risk. But the more you look at the individual risk, the more you think that it's pure noise, that people think that they have a low risk, a high risk, and it's, I mean, we didn't manage to correlate this to anything interesting, including their what we call the objective risk. It doesn't seem to be very well correlated.
We need to keep in mind that 2 generations ago, the dependency risk was non-existent, and so we have an anthropological story here that people have to learn about the risk, and there is no experience about that, and so there is a lot of ambiguity about the probability, those probabilities. So that's not an easy problem to solve for individuals.
You're right, and there is indeed a paper in the literature showing that you have a much higher take-up of insurance among the people who had to take care of their parents for dependency. So once you get aware of the problem, you start thinking about it and you start buying insurance. But probably people were.
That's fascinating. Okay.
Do you think so? I have in mind some work by Jean Tirole about the fact that people may choose their beliefs, and Christian also has worked on that. And sometimes they strategically ignore some information because it's costly to learn. You don't want to think about these things. So do you think this may matter here? People don't want to think too much about what will happen in some decades. It's they feel bad if they think about it, and then at the end of the day, this creates some specific distortions of perceptions.
That's a very good possibility, but how can you test for that? Because it's easier to see whether there is a relationship between what we think is the true value and their value, and to see that the relationship is basically not there. And then you have to explain why people think what they think, because what they think seems to be very different from reality. And then there are tons of things that you can advance. But as I said, we didn't do a good job at finding in the data what could explain the very specific beliefs of the individuals. So I'm very open to what you say, but then you have to tell me, for given individuals, what makes this individual think that this probability is 10% or 70%, while in reality his probability is in between. So if people don't use their own individual characteristics, what do they use? What can we explain? But for me, basically, that's the challenge with behavioral economics. It's if you think that people are rational, you can very well predict what they think. But if they are not rational, then you open the Pandora's box. It's very, very interesting, but then it's difficult to relate things.
Okay.
But anyway, for insurance, I'm sorry, we are saying that even if you correct the misperceptions, that will not be the silver bullet for insurance, even correcting these misperceptions.
Are there other questions?
I might have just one, but that's the insurance.
I propose to.
Sorry, Stefan?
Yeah, go ahead. Sorry.
Yeah. I just want, that's the insurer talking. The compass, so the measure of the actual risk, was using. What kind of variable were you using for, and to what extent your model is really replicating the actual risks?
Okay, good question. So the nice thing is the sequentiality of the stuff. So the compass model was done by the same co-authors a couple of years ago, and then we came with a survey. So in the survey, we of course asked exactly the specific questions that were used to calibrate the compass model. And these were information about the economic characteristics of the people, their age, also health characteristics. Everything that basically in their previous work they thought had some explanatory power for the risk of the people. And there they worked with the Canadian insurers, and so they had access to exposed situations of the people, and so they could compute what were the specific problems that the people were facing. And more technically, it's a Markov process thing. So it's a model that you replicate and that gives you transition probabilities. And then you run this model for thousands of times, and this gives you the average probability for each individual to do this. And it was done for Canadians, and we applied it to Canadians. So on this side, there are no discrepancy between the two pools of subjects.
Thank you.
Okay, so now I propose to take a break. So we will have the second session, say in 15 minutes. It's okay, a good break because we are. So Nicolas will share the second session that is more gender balanced with the two girls, because it was too less gender balance the first session. Sorry. Okay, see you in 15 minutes. Okay.
Nicolas?
Yeah.
Salut.
Milo?
Salut, ça va?
Ça va?
Juste pour être sûr que mon écran marche bien, non? Vous voyez bien les fonds de l'écran?
Est-ce que tu peux... Alors moi, je te vois bien.
Okay.
Tu veux partager ton...
Si je partage mes slides,
ouais, c'est bon, on voit très bien. On voit très bien.
Ok. Non, c'était pour l'arrière... L'arrière-plan, là.
À l'arrière-plan, on te voit très bien aussi.
Okay.
Voilà, tu vois très bien le bâtiment TSE, pardon.
Super, c'est ça, c'était le but. Ok, super. Donc,
à tout à l'heure.
Merci.
might be risk seeking. And then you take decisions based on these risk preferences, and there will be payoffs based on that. And these payoffs go basically to each individual. So then this basic concept is then obviously also transferred if we talk about risk taking by households. So in this case, I say households, but actually what I mean is couples. So we take households, we take couples, and we assume usually that each of these households has some risk preferences. Some might be risk averse, some might be risk seeking. And then they get payoffs based on their decisions that go to the household. Okay. And so basically there are two levels here where actually couples or households are different from individuals. We have two individuals here and not just one. So that means these two individuals might have actually different risk preferences. Okay. So one level where a household differs is that we have to think about an aggregation of these different risk preferences into the household risk preferences. I'm actually not talking about this level, so there has been some literature on that. But I'm going to talk about the second level, because also a household will not receive money necessarily to the household, but payoffs might be going to the individuals. Okay, so actually the fact that there is a joint account for the household is something that we have to prove, or that we have, that's actually not always the case. Some households might be doing it, but actually not all of them do it. So payoffs might be actually at the individual level. And so to which degrees payoffs with respect to risk are individual or are jointly depends also a lot on what kind of risk we're talking about. So this literature that's interested in risk taking sometimes talks about actually monetary risk, so investment risk. We've talked about this in the first session. Sometimes we're talking about insurance risks. Sometimes we're talking about even other kind of exposures to risk, like health risks, like who goes shopping in a pandemic, right? Who takes certain kind of exposures to get sick. And if you think about these different types of risk taking, actually the payoffs are very different. So if we're talking about monetary investment, returns are actually very often of the kind that we have in mind, that there is a payoff to the couple to a joint account. So very often the couple might have a joint bank account, do a joint investment, the returns come basically back into this account and are then shared. However, if you think about insurance, actually usually it's not the household that's insured when we have a health insurance, or if we have an unemployment insurance, but it's the individual that is insured. And so actually, if there are some returns, in the first place, they go to the individual. And then, of course, they are monetary, so they can be shared with the other, but this sharing is a second step that we basically have to think about. And then, of course, if we go even further, so when we're talking about health risk, we have, again, a completely different kind of situation, because health risk, health costs cannot be shared. If I'm sick, I cannot transfer the sickness, basically this cost, to someone else. It's basically something that cannot be shared. So what we're basically interested in is to which degree this fact that the payoffs with respect to risk in a household, in a couple, are actually individual, and that there might be some inequality in these payoffs might influence actually the risk taking by households. So this is basically what I just wanted to introduce to you. So in households, you have to realize that there are these two differences with respect to individual risk taking, so that we have the overall lottery, obviously, but then we have the distribution of these risks and payoffs at the individual level. So I'm an experimental economist. So I work with participants that come to a lab and do decisions. And over the last years, there has been an increased interest in studying how couples take decisions in laboratories, in controlled environments. And so this, just to tell you, there has been an increasing literature, for example, that's interested in risk taking. But most of this work has been usually just looking at what's the overall household risk preferences, so are households risk averse or risk seeking, and how do these different risk preferences of the individuals basically aggregate. So that's the first level I was talking about. Then there is also a second literature that's been interested in, do households share actually their individual incomes? Do they pool it in household public goods and so on? How do they react to inequalities? And there basically one of a very important result is that very often households react very strongly to inequalities in individual payoffs, and that they do not necessarily act in what would be seen as efficient, as they don't necessarily act in an overall maximizing way for the household if this would increase inequality between the individuals. So what we want to study basically in this work is what happens if we introduce inequality in a risky situation for a couple. And then the second step is what happens if we basically start to change an initially symmetric situation into something that's slightly asymmetric. So I'll show you how this exact situations that we're interested in. So I think this will become much clearer then. A very important point at the beginning, so we're going to be interested in the household's preferences. So actually in our experiment, households or couples took decisions jointly, so we don't have the individual preferences. I think this is also something obviously that could be interesting, but we only have basically the household's preferences in our data. So just a quick preview on what we find or what we do here. So we study basically what real couples that have that are living together, that come to a laboratory and take part in a laboratory experimental risk-taking task, how they behave in this joint risk-taking task. And we find that basically if we introduce inequalities in individual payoffs, that this has an impact on the risk-taking of these couples. Overall, most of our couples are risk-averse. So this is also not surprising. Also on the individual level, most people are risk-averse. The couples overall act very risk-averse. But actually, when then in a second step, we introduce these asymmetries, and we do it such that the man carries more risk in the low-risk option, then suddenly we see that there is a switch to actually a risk-seeking option. So it seems that this risk aversion preference of the household can be influenced if the distribution of the risk between the man and the woman is becoming asymmetric. So you'll see this in more detail later on. So let me show you what we do as a task. So this is a very simple experiment. So these couples come basically into the laboratory. They do actually a number of different tasks, but I'm only going to talk about this risk tasks today. So they are given these two, this decision here. They're given two options, and they have to basically decide whether they want to choose option A or option B. In each of these cases, you see there's the husband and there's the wife. And then we tell them basically there's a lottery that gives them this 50% probability, either black or red. And you see the payoffs here in blue or in orange for the husband and the wife. So this is, as I said, this lottery that we basically propose has individual payoffs. Now, what are these lotteries? So in this case, you see the lottery on the individual level is always the same. So it gives you either 150 or say 150. Don't worry about this is our experimental currency. But in option A, basically what we do, we correlate these payoffs. So basically, if they are lucky, both of them are lucky and get the high payoff. If red comes up, they're both unlucky and they get the low payoff. In option B, basically the couple can hedge the risk because if black comes up, basically one of them will win while the other one is losing. If red comes up, the other one is winning and the other one is losing. So that means basically on the individual level, it's always the same lottery. But now on the household level, option B is basically a safe option, and option A is a risky option. Then we are going to introduce some variance on this. So this is the first decision they have to make. So as I said, this was 150 and 350 as payoffs. And then we basically introduce in this option B a larger and larger inequality between the individual payoffs. Okay, so that means option B always stays a safe option because they always can hedge in their risk against the other. But in the fourth decision that they have to take, basically they both have a lottery between 0 and 500. So one of them will have nothing while the other one gets 500. Okay, so they're basically in the last situation, there will be a very large individual inequality in payoffs. So what we want to see is basically, first of all, in the very initial situation, we want to see whether they have a preference for this option B, so whether they are risk averse. And then we want to see if we increase this inequality basically from this first decision to the fourth decision, whether there is going to be some impact on which of these two options they are choosing. So whether actually an increase in the inequality pushes them to take the more risky option on the household level. So as I said, so these are laboratory experiments. It's very simply done, paper and pencil in a room. We did this in Toulouse with 100 couples that came from a varied age range, so from 20 to about 60 years old. They are established couples in the sense that we asked them to, they could only register if they've been living together for more than 1 year. The average duration was 8 years. They've been living together. About 44% are married, and 11% have a civil union contract, and 40% have common children. So actually, this is not. This is obviously a small sample and a somewhat biased sample, but it's not so bad actually compared to the overall average for Toulouse. These participants are paid for their participation, and they are basically paid based on these decisions. Okay, so what I showed you, these numbers are actually transformed into euros at the end of the experiment with the exchange rate. They did also other tasks, but overall they could earn on the individual level up to 60 euros. So this is quite substantial for 2 hours of presence. So many of these participants are also really motivated by increasing their earnings from that. So I will show you basically results from this first task that I showed you where these payoffs are symmetric. And then I will show you results from a second task where we will introduce some asymmetry where one partner basically holds less risk than the other. So this is just so you have an idea how this looks like. So they are really sitting next to each other at a table. They can talk, they can discuss, they get lots of instructions, lots of, we ensure them that they really understand these decisions and the probabilities well. And now let me show you what we find. So in this joint decision task, first result that we observe is that there is a very strong preference for the safe option by these couples. So 80%, 81% of these couples choose this B option. That's basically on the household level, the safe option. So couples are very risk averse. So this is the first thing that you should take away from this. The second thing that you see is 1 to 4 are these 4 payoff variants that I showed you. So basically from 1 to 4, we increase this inequality in this option B. And even though it's not a very large effect, we still observe that there is a small effect to more risk-seeking choices in this fourth option. Okay, so basically this depends obviously on how much more risky one or the other option is, but it seems that increased inequality has some effect also on the overall willingness to take risk for these couples. So overall, these couples are very risk averse. A large proportion of these couples are also very consistent. So they 65% always choose this B option. So this option that allows for some hedging. And this brings me now to the second part of the study, where we want to introduce some asymmetry, because hedging is basically only possible if both have exactly the same risk. So what we are going to do now, we're going to remove the individual risk of one of these players. This obviously increases the risk for the household, but it might also bring the focus basically on the person that is still holding some risk. Okay, so basically that's why we talk here a little bit about insurance, but you have to be careful what you have in mind. Basically, we change the situation such that we take away the risk of one of these players artificially, so they do not insure themselves or anything billing. So let me show these choices. So these are now, again, so they do the same type of task. These are two more choices. Again, they have to choose between an option A and an option B. Option A is the same as I showed you before. In option B, you see now that basically the woman here now is not exposed to any risk. So she has always a payoff of 250, while the man holds the same lottery as before. Okay, so we basically take away the risk here from the woman. So she just gets the expected value from the initial lottery anyway. So this, obviously, if we do that, increases the risk for this option now. So option B now also becomes a lottery. It's not a safe option anymore on the household level. But on the household level, it's still safer than option A. Okay, so a household that's really risk averse should still stay with this option B, because on the household level, it's safer. Then again, we have two variants. So we have one situation where the payoffs for the uninsured person, so to speak, is 350, 150. And then we increase the inequality to 400, 100. So basically, in this situation now, the uninsured person, as we call him, the husband in this case, would have a lottery between 400 and 100, while the other partner has no risk at all. And here now it might or it will depend actually who is holding the risk and who is not holding the risk. So in some treatments, so in some sessions with some participants, it's the woman that is insured, so that holds no risk. And in other sessions, so for other participants, it's a man that is holding no risk. So we can compare basically what's happening if either the man or the woman is exposed to this risk reduction. And here we observe now some interesting variations. So basically, if in situations where the man is insured, about 78% choose still this safe option, so this option B. So this is very close to what I showed you before. So I told you like 80% are risk averse of our couples. However, when the woman is insured, this already drops to 65%. So more couples basically start to switch to the more risky option. And this difference becomes even larger when we increase this inequality. So this was this choice number 6, where we have now the payoff between 400 and 100. Now, basically, if the woman is insured, so there is a focus on the man holding all the risk, there are much more of these couples that switch to the more risky option. So now it's important that as I told you in the beginning, we are only studying here household preferences. So they took these decisions jointly. We didn't record basically the bargaining that was going on, the arguments that were brought up by the man or the woman in this decision. So this is something we would like to study in the future. So we cannot say, is this now due to men having a certain preference or women having a certain preference? But what we seem to be able to say is that spouses jointly have an aversion to a situation where the man is basically holding all the risk while the woman is risk-free. So they're basically, this kind of aversion seems to overrule their overall risk aversion and leads them to a situation that's actually more risk-seeking. So that's what I want you to take away from this this short paper, that I, first of all, risk-taking in households, in spouses, is influenced by the individual payoffs and by inequality in these payoffs. And that if this situation becomes asymmetric, so if one partner holds more risk than the other, this influences behavior, and that couples seem to be actually very averse to a situation where the man holds these kind of risk. So as I said, we don't know whether this is due to the preferences of the man or due to the preferences of the women. This is actually work we would like to do in the future. We also, actually, as I said, so I started this as a motivation on household decision making. This is obviously about couples, about spouses, but actually it would be very interesting also to extend this to other types of relationships in a family. So, for example, very often parents take insurance decisions for their children. Sometimes it might be extended to middle-aged people taking insurance decisions for their elderly parents. All of these situations basically always are influenced by the individual's risk preferences, but then also by the joint decision that's kind of made by the household. So thank you very much for your attention, and I look forward to questions.
Thank you, Astrid. Yeah, that's very interesting. While there are thousands of experiments on individual behavior, there are so few on let's say collective and household decisions. So that's very interesting. So if you have any, I don't see any question in the discussion. So if you have any question, please unmute yourself and ask it.
Yes, maybe just one small point. Astrid, do you think it's really that couples don't want the husband to, the man, in fact, to be holding risk, or is it they don't want him to be running the risk of earning less than the woman? Do you think you would have the same results if the payoffs were such that there was risk, but he would always earn more?
Yeah, no, that's exactly. So this is a question we cannot answer actually with that. It's not. It could be, as you say, it could be that it puts a focus on the situation where the husband gets less. But you know, it's a funny thing, right? It's symmetric. So in one situation, he earns exactly the same amount less than he would earn more in the other situation. So, but yeah.
It's not symmetric in how it's perceived, probably.
Yeah.
But, yeah.
So Christian left, so there are no questions. No.
You have a question or remark? Yeah, go ahead, Aisling. I was
just a remark that it's interesting research. I think still maybe trying to absorb some of it and try to think about what's driving these decisions, but certainly interesting experiment.
Thank you.
I have
Francesca?
I have just a quick question for Astrid. Are this couple all married with, no, they are not married. Do they have children?
Yeah, so lots of them, I mean, I think, no, I forgot, 40% I think have joint children. So I mean, not all of them have children, but yeah.
You didn't find any effect?
We didn't, no, so that's the problem also. It's a rather small sample, right? It's hard to get into we have lots of socio-demographic information about them. So, but no, there is no impact of that on this behavior.
So from standard theory, it seems to me that there are like what should matter in principle is the individual risk preferences. and the contract, implicit or explicit contract the couple has together. So do you have any follow-up plan? I think at the end you mentioned that, but to learn about these individual preferences and maybe the implicit contract, the way they share money, the marriage, the possible follow-up experiment with the marriage contract and so on, to see whether it affects the risk sharing?
Yeah. No, so this is exactly the thing. So actually, as I said in the beginning, there's an increasing interest in the kind of contracts that are going on in households, and so from the economic point of view, it's usually assumed either you have two partners that are in competition with each other, or you have a household that thinks only in household efficiency terms and is budgeting basically everything together. However, as we observed also we've been doing multiple studies on this kind of situations, is that people have a mix of these two in mind. So it's actually in a household thinks sometimes as a household, but sometimes also as individuals. Maybe not so surprising, right? So basically, an inequality in households plays an important role. So households basically take also the inequality between the different members into account. But it's not only the inequality that matters. And yeah, it would be interesting to figure out basically what is driving that. So it's driven to a certain degree, as we've seen in other studies, actually by whether they are married or not. So marriage makes households or our couples usually report more income pooling, so that they think basically about a joint account, but it's not only that. So yeah.
Astrid, also this, sorry, I was disconnected and I took time to reconnect, and so I missed part of the talk, but I thought it was, what I heard was really fascinating, and I really find it's really interesting to study the couple decisions, because as you said, a lot of decisions are made in this way, so we have a lot to learn about that. And this reminds me, in terms of studying the preferences of couples or groups of people, reminds me multivariate, you know, all the theories about multivariate risk aversion and correlation aversion, this type of stuff. Like when you have two attributes in your utility, in your supra utility function, maybe the earnings of the man and the earnings of the woman, or the different people in the household, you could have risk aversion on some parameter, on some specific dimensions, but risk seeking on another dimension. And so in a sense, it's completely studying the individual preferences, and the household preference could show very different types of preferences. Yeah. And so I mean, it reminds me this, you know, by Richard and also Epstein-Tani, about correlation aversion.
Yeah. No, and I think we know very little about how couples basically trade off, you know, who buys some kind of either risky option or insurance option, and how what kind of discussion is going on behind basically what they, you know, either if they think that risk is correlated or not. So yeah.
Yeah, because, you know, in a sense, do you prefer to be happy at the same time as your partner, or do you prefer to be both in the bad position? I think, and so that would be a preference for correlation, which is completely independent from your risk preferences. You see what I mean? Which, do you want to be in the same, and so that's, or maybe you prefer that one is happy, the other not. I mean, I don't know. I mean, myself, I'm more correlation lover, but in this dimension. But
you are so romantic.
Yeah, I know.
Well, I think it also, I think it goes back to what I tried to mention in the beginning. It depends a lot about what we are talking about, right? If we talk about risk that's related to money, maybe people think like they can transfer it to the other, right? If I'm lucky and I get a lot of money, I can still give it to my partner, right? But if you are sick, right, are you correlation or anti-correlation averse? I don't know. You might say you want to be both sick or both non-sick, or you say rather one of us is sick and the other one can take care of the other, right? I think there are good reasons for both. But I think it's these kind of thoughts that probably drive the decision and the preferences.
Okay, thank you, Astrid. Very interesting, very stimulating. And I think now we can leave the floor to Francesca.
Okay, I'll share my screen. Can you see my screen?
Yeah,
okay. Okay, so thank you very much for inviting me and for the opportunity to bring another point of view in the study of risk decision making. I'm not talking about insurance in non-human animals yet, maybe in the future. There are some direction for new studies here. But what I would like to do is to give you an overview on the work that has been done in other species, so and especially in the non-human primates that are monkeys and great apes. So I'm a comparative psychologist, and I'm broadly interested in how cognition is diverse or similar between humans and other species, and in particular, how different kinds of decision strategies have evolved in different species. So as we have discussed before, and Astrid has reminded us with her colorful first pictures, there are a lot of variation in decision-making under risk in humans that goes between populations. So we have differences in risk propensity across nations, but also across small-scale subsistence societies. We have individual variation, and usually men tend to be more risk-prone than women. And we know that risk propensity is not a stable trait across human development, but it changed. And then within the same individual, we know that there is context variation. So individuals tend to take more or less risk according to the currency of reward at stakes. Like, for example, difference between if you're making decision for getting more money, or like in the foraging context to obtain food. And also that the social context at large influence how people perceive risk. And finally, we also have what is called internal state variation. And we know the emotional states can affect individual preference. And we have talked about disappointment and regret. So what is the question that is very important to understand is what is the origin of this variation? And I would say there can be two main explanations for this. So one is that this variation is mostly driven by cultural experiences. So for example, there are studies in anthropology that show that subsistence societies that are more involved in the market, so they have more market experience, they tend to be more risk prone than in comparison to other societal cultural groups that are less integrated in the market. Then we have cultural norms. So there are evidence for collectivist societies to be more risk prone than individualist societies. And then we can have also socialization practices. So for example, men, and the difference between men and women can be due to the place that women and men have in the society as a whole. But on the other side, and I want to point out that these two are not mutually exclusive, and we can also have some interaction between this explanation, are that these preferences are more like related to biological contribution. For example, genetic differences, and there are studies showing that homozygous twins, they have the same risk preferences. So there is a component of hereditability in these preferences. Then also hormonal status can affect risk choices. For example, testosterone, increasing the level of testosterone increase risk seeking. And also that this can be due to maturation of the neural system recruited in the decision process. For example, the maturation of prefrontal cortex or orbifrontal cortex, there are two brain areas involved in this kind of decision. So Studying these together in humans can be very difficult because humans are made by both. So we have biological influences that are shared with other species, but we also have unique cultural influences. So that's why I want to convince you that non-human primates, which are our closest relatives, so just to give you an idea, our lineage diverged from great apes around 6 million years ago. And they can help us to understand what are the biological foundation of human behavior, and especially to disentangle between these biological influences and cultural influences for three main reasons. First, they share with us similarities in cognition, but also neurobiological substrates. For example, studies on rhesus macaques have shown that the same neural circuit and brain area activates when macaques make decisions under risk, as similar to when humans make decisions under risk. Then we have similarity in social behavior, with sometimes we have different behavior in male and females. We have sex differentiation in both behavior, but also in the brain. And the same, we have a long development, and sometimes some brain regions have the same behavior, the same developmental trajectory in humans and other non-human primates. And the most important thing of all, that despite all these similarities, non-human primates lack human-specific form of culture and an economic market. So they make a very strong test to disentangle between these two. So, and importantly, you might wonder what animals can do, why we can use them. And actually also non-human animals make decisions about value in their everyday life. They don't make decisions about insurance or investment in stock market, but they need to evaluate cost and benefit when they select what food to choose. So where to look for food and what kind of food is the best for them. When selecting which is the best mate, and also when selecting which is the best ally during a conflict. All these decisions share two main components. One is time. So all these rewards, when you get food or when you will be able to find a good mate, they are not immediately available, but they need to be pursued, and so they are distant in the future. And also there are risks, because all these gains are variable. And they don't know which is the probability, but they are variable in their rate of return. And this is why, beside economics and psychologists, also biologists have been very interested in how non-human animals deal with this kind of situation, and what is the currency that they are trying to maximize. And contrary to optimality in economics, in evolutionary biology, when making decisions, individuals are trying to maximize their fitness, which is the number of the offspring for individuals. And this is measured by using as a proxy, by using food or calories intake. And so this was the framework background. So now the question is how we measure risk preference in non-human species, since we cannot ask them with questionnaire. So risk preference in non-human animals are usually assessed by presenting them different choices between a safe option, that is constant amount of food, and a risky option that can have a variable amount of food. For example, they can choose between 100% probability to obtain 4 pieces of food, here for grapes, for example, and then a risky option, which is 5% chance to obtain either only 1 or 7. And this is just an example. You can manipulate the probability as you want. And with this kind of paradigm, many different animal species have been studied, starting from insects and then birds, but also rats and mammals, and of course, non-human primates. And it appeared that non-human animals are usually risk averse for gains, but this is just, don't get too excited about this, because it's not the case always. And in fact, one of the main theories to explain risk preference in biology is called risk sensitivity theories. And this is kind of related to our talk our previous talk about how wealth affects human risk preferences. And here, actually, according to this theory, is the individual's energy budget that is the status quo under which these choices are compared. And according to this theory, animals that are in negative energy budget, that means they suffer hunger, they should be risk prone, while in a positive energy budget, they should be risk averse. And this is explained by the fact that when you are in a very negative energy budget, the risk option could be the only way to avoid starvation. Now, this theory works well and has been confirmed in a very small body species, for example, in birds and in rats and mice. But when we look at non-human primates, which are big animal species, this theory doesn't hold up. And I will show you that actually there is a lot of variation in how non-human primates take risk. And one of the explanations is that the ecological rationality hypothesis, for which differences in natural history are the ones that are driving this risk preference in non-human animals. And to explain this, I want to show you here, there are chimpanzees, bonobos, and humans. And although chimpanzees and bonobos are very closely related to each other, and they are very similar in body size, they show completely opposite risk preferences. So one species is risk prone, and the other one is risk averse. And if we look at the ecology in the wild, we will see that they have very, very striking differences in their feeding ecology. While chimpanzees feed mostly on fruits, and they sometimes hunt other monkeys, bonobos, instead, they rely more on herbaceous vegetation. So they basically eat salad. And these can share their preference because, for example, hunting has a very high degree of risk in the sense that you invest energy with a very variable gain. So to test this hypothesis, what I've done is to compare another species of monkeys, which is very distantly related to chimpanzees and bonobos, but share with chimpanzees the same ecological environment. So if it is true that the environment shapes the risk preferences, we should find same risk preference in capuchin and chimpanzees. And to further explain this claim is that if we look at wild capuchins, you can see that here they exploit very risky food sources. For example, this is a wasp nest. So they hunt, they eat the honey from here. This is they hunt small vertebrate prey. And here, this species in particular is famous because they use stone to crack and open nuts. And all this behavior, again, are risky in the sense that is an investment of energy for resources that is variable. So they don't know for sure if they will get their reward. So I tested 5 males and 5 females, 10. I know that the number are not, the sample size is not the usual sample size that you are used to work with, but these are monkeys and it's very difficult to have high number in the same place. So what have we done? We developed this quantity risky choice task in which they have the choice between a safe option, always 4 pieces of food, or a risky option. There could be either 1 or 7 pieces of food with different probabilities. So we present them with a neutral condition in which if they select the risky option, they had the 50% chance to receive 7 food items. So in this case, the average payout of the safe and the risky option was the same, 4. Then an advantageous condition in which they had the 67% chance to receive 7 food items. And in this case, selecting the risky option gives you a 5.2 food items, so a higher payout. And a disadvantageous one, in which they have only 33% chance of receiving 7 food items. And in this case, selecting the risky option will give you only 2.8 food items. They did this in the repeated choices for 10 times for each of the condition. And this is a video, I hope that it works, which you can see here, there's a safe option and a risky option covered by two different balls. The monkey can choose by, they can make their choice by inserting their finger in the hole, and then they are being rewarded. So what we find is that actually they have a pretty good flexible choice strategies, and they select the risky option only when this was when there was a 50 or 76%, 67% of receiving the larger option. But then the choices for the risky option decrease when was disadvantageous, when they only had 33% chance of receiving this the larger option. And this gives you an idea on how flexible can be the choices in this context. And when we compare all the species, when we compare capuchin and the chimpanzees and bonobos that I showed before, we can see that capuchin and chimpanzees that share a similar environment, they also share a similar tolerance for risk. So they are both risk prone, while the bonobos are more risk averse. And importantly, and we will come back to this point later in the talk at the end, there were no sex differences and no age differences in these studies. And this, the lack of sex differences and the age difference has been confirmed in other studies, but you need to keep in mind that the sample size is very limited for addressing this kind of question. So now this is an overview of risk preference, but then we talk about other, oh, I see. I will take the question later, right?
That's fine.
Okay. And so, yeah, but we know that there are other factors that shape risk preferences in humans. And one of these factors are emotions. So we know that emotion play a very huge role in affecting human risky choices, and especially people make choices that minimize the chance to feel regret. And we see the shift from risk seeking to risk aversion after gambling and losing. So what we want to ask if the non-human animals have a similar emotional reaction to the outcome of their choice. To do so, we measure monkey emotion by collecting and analyzing through videos some indicator of stress, which is in this case is scratching. And the scratching behavior is when they scratch part of the body, or also behavioral response that is the choice switching. So how many times they try to change their choice when they gamble and they get a bad reward. This is an example of, a switching. So here, Carl select the risky option and then only obtain one. And I see it was like, no, very happy, and it tried to shift his choice. So what we find is actually that here you can see the mean effect score. So we combine all the emotional responses in one score, and you can see that they have a negative emotional response more often after they gamble and they received only the one outcome. So when they lose, let's say they lose, then when they gamble and they win, or they select the safe option. And the same is true for the switching attempts. So these show that more negative emotion is switching after gambling and receiving a bad outcome. So they have this kind of emotional response, similar to the humans. But importantly, different from humans, we don't have an effect of this emotional response on capuchin's subsequent choices. And in particular, they keep choosing the risky option no matter what they feel and no matter what they get. So in this case, it's very, our interpretation of this result is that the emotion for them can have a cope function. So they can actually use emotion to cope with the fact that they have a bad reward. And this can also be a proximal mechanism that forces the evolution of a more risk-prone strategies. So there was the emotional, but also we know that social context affects decision-making, and people make more risky choices in the presence of others. And so we asked if this is true also with monkeys, because as humans, non-human primates live in very complex societies, and they make decisions with others, and sometimes the payoff of their decision depends on the behavior of the others. So social context is more important, is very important for them too. To check if the social context matter for the monkeys, we put them in 2 adjacent cages. So this one was our subject, and our subject can do the test, similar to what you said before, alone, or paired with a dominant bystander and a subordinate bystander, because since in these species we have rank, so there are individuals that are more dominant than the others, there could be a reason why when you are watched by an individual that is dominant, there can be an effect on your preferences. But interesting what we find is that no matter the rank of the co-specific, the mere presence of someone watching you alter your risk preferences. And in this case, they are more risk prone when they are alone than when they are watched by someone else. And if we look at the emotion, because we also got the emotion, we can see they are more stressed when there is another one watching them. So it is possible that here we can see a combination of emotional response, so a variation of the internal states that can be caused by the social context. So you can see this is an example of how these two are very linked together and intertwined. And so to just sum up what we found is that like humans, some other species, they are sensitive to variation in their payoff, so they can modulate their strategies. And then probably we find different strategies depending on the species, because it can be a response of the wild environment. They do exhibit emotional response to the outcomes, but this response doesn't have the same function as in humans. And they change the decision-making depending on the social context. So this is for sure that some psychological processing that are driving human decision-making strategies can be shared with other humans. And before leaving you, before finish the talk, I want to give you an overview of the importance of comparative approach and what this kind of comparative approach can in the future help us disentangle. So here you have the levels of variation. For example, I talked about population variation, species and population. And we have some evidence that there is an adaptation to the socio-ecological niche of the species that can be also translated to adaptation of the local environment of the different human population that we see. But also, and then further studies, future studies will help us to disentangle between this and between the fact that maybe there is an acquisition of local cultural norm and institution that is driving these preferences. At the same time, at the individual variation, for now, we have little evidence for sex and developmental differences, which again, is not confirmed because we need more studies on this direction. But if this is the case, then maybe this suggests that maybe the difference that we find in humans are more due to gender socialization or cohort effect. Like, for example, generational effect that Christian, I think, mentioned before. And then again, we have within individual variation, we know that non-human primates also have sensitivity to energetic state, emotion, and social context. And then further study of the social context in particular will help us to see if there are specific capacities that are only human, unique, and that are due for our extensive cooperation and for our tendency to social exchange. And this is very important because culturally based traits are more malleable and amenable to intervention. And that means that we can, if we disentangle between these two, we can have a new clue for promoting optimal decision-making, optimal economic behavior in humans. And I hope that I convinced all of you of that.
You did. Thank you very much. So Olivia had a question.
Yes, I had a question. I mean, first a parenthesis. I really enjoy this type of experiments with animal, trying to understand, you know, basic economic concept. I mean, my advisor when I was a student, John Kegel, who's a relatively famous experimental economist, used to do experiment with pigeons back in the day. So you know, it's good to see that his tradition has not been lost. Now, one question I have regarding this comparative approach. When you compare species like this, how can you disentangle risk preferences from probability perception? I mean, if you see that one species is more prone to engage in risky behavior, is it because this species is, as you know, lower, I mean, or different type of risk preference, or is it because they perceive probability differently? I mean, you know, we know what an objective probability is, or, you know, there's a good chance that humans know what an objective probability is, although that's not entirely clear. But what do we know about animals in particular? I mean, what do we know about the link between their subjective probabilities and the objective probabilities?
So for the second question, we know very little. The first question, we have now like the study of how they understand, or whether they understand or not probabilities, and then they are able to assess correctly or not, has been, now there is a flourish of new studies. And I personally have a study of that, showing that rhesus macaques, they make basic prediction according to the distribution of items in the population. So they can, let's say, estimate what is the objective probabilities involved. But the thing that we don't know, and this is true for rhesus macaques, for capuchin monkeys, and for great apes, and there is no difference in their understanding. So that point toward the more difference between their risk perception than their ability to understand probabilities. But there are no direct tests for this. And that would be a nice test to do, because yeah, you're right. Maybe it's a difference in the estimation of the objective probabilities that is driving all these results. But I will say, according to what we know now, that is less likely.
Okay, thank you.
Any other question? Or again, please unmute yourself if you have a question.
Yeah. Can I ask a question? Thank you, Francesca, for the very nice presentation and very interesting topic. And I remarked that you were studying risk aversion in capuchin monkeys. And if I remember well, there is a paper by Chen and co-authors. And if I remember well, their result is that they were risk averse on the gain domain, so which is your domain. And so I thought that the results were a little bit different, no? Because you find risk loving. So do you have an idea of whether you can concatenate, in fact, different studies on the same species to get maybe more data to see what is the most robust result? Or
that's extremely good question. And yes, I don't know if you remember that that study was done with token. So the capuchin capuchin and other species of monkeys, especially the great apes, they are able to trade, to exchange with experiment objects called token that are associated a certain value. So that was
to apples. Then after they exchanged tokens for apples. No?
For apples in that study, yeah. But they can learn to associate each type of token for many. So that is a very different procedure, also because token seems to have what is called in psychology is a psychological distancing effect, because it helps you, since it's not food, but it's an object, it helps you to make, let's say, more rational choice, in the sense that you're not saying directly the food. So there is less self-control involved. And that could be why in these studies, we found another partner of choice. And also in our setup, we didn't include a loss condition. So that can be done in the future, I think. There is also another thing to check, because when you add another condition, then usually you do the condition on the same day, And there is a carryover effect that you can have, and that can affect the result. So I agree with you that in the comparative literature in general, what we need to do is to have different studies, maybe with the same methodology or different methodology, and see if these methodology are measuring the same construct, since risk is not very easy as itself. But one thing that I can tell you, because in the capuchin monkeys, there are few studies. There is the Chen study and the Laurie Santos group studies and our studies. So it's not many, but in chimpanzees, there has been studies more. The risk preference that they find is constant across studies. So they are risk prone across studies. And this is something that say maybe, at least in that species, that preference is very strong. And this is important also to point out, in chimpanzees, they found the same risk preference in captive population and non-captive population. That could be another confounding effect that you can have. I don't know in capuchin, we need more studies.
Yes, thank you. Just one comment. So I think it's interesting what you say about tokens, because I guess it could be also the same for humans, that if you are gambling for money, it's not exactly the same. I mean, there have been studies also, if you gamble in front of like someone making a cake and you can see the smell, and then you don't have the same. So I guess the intermediation role of money, when an insurance contract in which you're paid out of money or paid out of different goods could be also inducing different behavior. And just a comment, when you say that being risk lover is not being irrational, I mean, I think it's fine. It's just a principle.
Yeah. Oh yeah. Sorry. Yeah, and for your last point, I do have studies with humans subjects that show that, maybe I will send you the paper that show that when you use food and money, you have completely different behavior. So people tend to risk more with food than with money. And also we manipulate how we presented the choice. So we have the same task that you saw before with the monkeys, which they have to lift the balls, or we presented them on the screen. And we also find that with the balls, they were more risk prone than with the screen.
It's interesting, because I would have expected the reverse, you see, because I would say that, because if you are talking about food or particular items, there is kind of a satiation effect. Like, you cannot eat like 10 pieces of cake, otherwise, you are going to be sick. Whereas with money, there is not this satiation. So you would expect that you could be more prone to take risk for money than for food, but actually you find the reverse. So yeah, I would be happy to read your paper. Yeah, thanks.
Yeah, we'll put in the chat. And yeah, you're right. But the thing that we controlled, and maybe, I don't know if this is the explanation, but we made the condition the same, so they can take home the food. They can accumulate both the food and the money.
Yeah, so then it depends on your household preferences, whether you share with a partner, and then we are back to the, yeah. And if you can store it.
Okay, guys, thank you, Francesca, for the very interesting presentation. And I think now we are going to switch to the last presentation by Milo.
Yes. Let me share my presentation. Can you see it? And can you hear me?
Yes, we hear you and we see well.
Great. So thanks a lot for inviting me. It's a pleasure to be here and with you and to present this paper, which is joined with Marie Brière. She's at Amundi and at Paris Dauphine. So the paper is going to be an empirical paper trying to understand how investors interact differently with human advisor and with robot advisor. And we will have a particular focus on small investors. So robo-advisor provide financial advice based on automated procedure. And there has been recently a lot of interest in robo-advice, both in the industry and in academia. So in the industry, part of the reason is the fact that is given by the fact that the market is growing very rapidly. the asset under management which have been estimated under the control of robo-advisor in 2016 was about 100 billion, and today is about 1 trillion. And is projected to continue growing exponentially. Now, in academia, we are interested in robo-advising for a few reasons, and I'm going to list those that I think are the main question, or at least the most interesting question for us. The first is whether having access to automated advice improves financial decision. And the reason we are interested in this is that there are ample margins, and some of these have been discussed today, and more generally, behavioral economics and behavioral finance have accumulated evidence on systematic mistakes that investors make, and have estimated the importance of these mistakes, both for individual welfare and also for the functioning of financial markets. So there are ample margin of improvement for individuals, but there are also ample margin of improvement for advisor. Okay, there is evidence that advisors are not always making the best interest of their clients, either because they don't know how to do it, or because they don't have the incentive to do it. Okay, so there is some hope, and I'm going to elaborate on this, that robo might help in this dimension. The second question is whether automation promotes financial inclusion. Okay, are we able to reach investors and reach individuals more generally who have been traditionally excluded from financial services, thanks to the fact that the robo has lower cost of providing the service, and maybe it's also better perceived by investors. And I'm going to tell you again a little bit more about this. And third, and more broadly, we are interested in understanding more generally robo-human interaction, whether investors interact differently when they have a robo advice versus a human advice, and more generally whether there is substitution or complementarity between human and robo. Okay, let me elaborate a little bit on the argument which have been put forward on why robo advice might help financial decision. The first and most obvious, but also very important, is that they have lower operating cost. So it's just a matter of fact that we observe that relative to human advisor, robo have lower minimal capital requirements to access the service. They charge lower management fees. So there is some possibility that they are more inclusive. Okay, they can reach smaller investors. The second is that robo are based on accountable procedure. You can potentially verify the procedure that the robo are following to give advice or to implement some portfolio changes. And this might improve investor trust in this service. And so again, most possibly improve investor participation. Third, and maybe more fundamentally, the robo might use more information. We can aggregate a large set of information into the algorithm, and it can potentially also include different sources of information which is non-standard, information which has not been used traditionally in financial services, say consumption pattern of the individual, or digital footprints of the individual. Okay, and there is evidence that this starts to be done. And fourth is that the robo might propose recommendations which are highly tailored to the individual, and that occur at the time in which the individual has to take the decision, so in real time. And this is has been shown to be possibly a good instrument to try to debias investor, knowing that debiasing investor is typically very difficult. So that's in terms of financial decision. More generally, in terms of human-robo interaction, we think it's particularly important or interesting to look at financial advice, because financial advice is somewhat special. Okay, trust is key in financial advice. It's a central element in financial advice, and it's also a central element of the adoption of new technologies, and in particular of automated advice. Okay, there has been contribution in the economics literature proposing that going to the financial advisor is a little bit like going to the doctor. So the key aspect that the key role that the financial advisor has is to reduce the perception of risk that the individual has. And the question is whether the robo is able to play this role of money doctor or not. And the second is that there is survey evidence and a lot of evidence that not everybody is willing to accept automated services. And so there is this concept of algorithmic aversion. And algorithmic aversion is particularly sensitive, so particularly important for sensitive decision, like in the medical sphere, but somewhat the financial service is, so we observe even larger level of algorithmic aversion for financial services. The second aspect that we think is important in this broader question is that it could be also because of the reason I just mentioned, that complementarity is important. I don't have to, I guess, to stress this in this audience, but there is a lot of debate also in the industry of the extent to which robo will replace human in their jobs, whether also as a teacher or as a researcher. You will see, the next SCORE conference will just be given by a robo, both as presenter as discussant. So in context of financial advice, we ask whether the investor view the robo as a substitute for their own judgment, for their own attention, or a complement. Okay, whether they still want to keep an eye on their portfolio, and whether they want to interact with the robo. Okay. So more specifically, what we do, we study the introduction of a robo-advisor by a large French asset manager on a particular investment product, which are employee saving plan. And I go back to this because it's an important part of the study. And we are asking the following question. First, we're going to look at who takes up the robo, and we're going to see whether which type of investor exhibit larger aversion to the robo or to algorithm, and we want to ask whether those investors are those who need the advice the most. And we're also going to ask whether this investor interact differently with the robo relative to human advice. And just to preview some highlights, we see that the robo is able to attract a small investor, and the robo is able to implement large changes in the portfolio. And both these elements are important because they are pretty different to what we observe with human advice. The second aspect is we're going to look at whether investors are more attentive to their portfolio after having taken up the robo. And we are going to observe that, in fact, attention to the portfolio increases after having taken up the robo. So this is consistent with the view that there is complementarity, or that investors perceive complementarity between their own thinking and the robo. The third aspect we're going to look at are the effect of the robo on portfolio choices and on returns. And a key aspect of the study is that we can follow individuals over time. And in fact, a lot of important effects that we're going to focus are occurring after individuals have taken up the robo. Okay? It's not only that they change their choices at the time in which they take the robo, but the robo is able to induce choices, different choices also over time. And in particular, we're going to show how individuals who take the robo will increase their risk exposure, and they will also enjoy larger returns, larger risk-adjusted return. And moreover, they will rebalance their portfolio in a way to stay closer to their target portfolio. Okay, they will, in a way that I will explain after. The robo is able to induce investor to stay close to the target. Okay, for example, not to panic when the market goes down. Okay. Fourth aspect we're going to look at is related to financial inclusion. Okay, we are going to see whether the effect that we investigate are larger or not on investor which we think have been traditionally excluded from wealth management services, so those with smaller portfolio, and in fact we're going to show that the effects are larger for them. There is a growing literature on there are many studies, I mean a few studies in the past 2-3 years on robo-advice. Maybe the key distinctive feature of our study is that we focus on small investors, and that we focus on choices over time. Okay, so how the robo is able to change choices over time. Okay, let me give you a little bit more details on the type of investment or type of products we are going to look at. These are employee saving plans. So each year the employees receive a sum of money that they have to allocate between a menu of funds which are proposed by their employer. The investment is rather long term, so is locked in either for 5 years or until retirement, depending on the contract. And employees can increase their investment and rebalance their portfolio over time as they wish. The robo was proposed in September 2017 by the asset manager. So the way it worked is that the asset manager was proposing to some employers the robo. If the employer accepts the service, the employees are informed about this possibility, and then of course it's the employees are free to choose or to accept the robo service or not. And what the robo is doing is pretty standard. Is asking a series of questions to the investors, and there are a few questions, but essentially they are then aggregated into 3 key dimensions. One is risk aversion, the second is financial knowledge, and the third is the horizon. And once this information is elicited, the robo proposes an allocation, and the allocation which is proposed depends on these 3 dimensions in the way you would expect. So if you are coded as somebody with low risk aversion, I will propose you larger amount of equity. Same if you have somebody with larger financial knowledge and with larger horizon. And if the investor accepts this proposition, the robo will implement the proposition. Okay, so this is the typical screen that the investor would see at the end of the questionnaire. In this case, the investor was coded as somebody with moderate risk profile on a scale between prudent and audacious. And given this profile, the robo is proposing the asset allocation, which is on the right here. Okay? And the investor can compare the allocation proposed by the robo with the current allocation that he has in the plan. Okay? And of course, the investor can also click on the proposed allocation and see in more details which type of funds are behind this proposed allocation. Okay. So the type of data we have are one last thing about the robo, which is important, is that the robo is then following the investor over time, and you will send email alerts if the current allocation is too far from the proposed allocation. Okay, so if the investor is, let's say, putting new money in the plan, or if there is a market shock, so that the current allocation becomes far from the target allocation, the investor will receive email, and in that case, the email will ask the investor to connect to the platform and to make some rebalancing. But that's again the choice of the investor. Okay? The investor is free to do it or not. So we have monthly data on which come from the asset manager on which are account level data. So we have portfolio choices. We can construct returns. We can construct measure of risk. On top of it, we have digital footprint data. We have the number of connection, the time spent on the dedicated platform, which we'll use as measure of attention to the portfolio. And then we have data that comes from the robo. So we know how the robo is profiling the various individuals, which allocation is proposing, and more generally, we know exactly the way in which the robo function, and you're going to exploit this knowledge in our empirical analysis. Okay. We have about 14,000 robo takers. These are people who have chosen to delegate their portfolio management to the robo, and we want to compare them to people which are as much similar to them. So we extracted random samples of people which were proposed the robo and did not take it, and a random sample of people who were not proposed the robo because the employer were not offered the service. And we have also a sample which is pretty interesting. These are, we call them robo-curious. These are people who went through the service, and in particular, they got, let's say, to this screen. So they were profiled, they were suggested an allocation, but then they refused to take up the service. Okay. So for those people, these are interesting because we know exactly what the robo would have done if they had decided to subscribe to the service. So first question is, who takes up this robo? So we have many variables here, but let's look at the column 1. Column 1 is telling you who, conditional on being offered the service, takes up the service. And you're going to see that the probability of taking up the service is negatively related to age. So young people are more likely to take the service. Male investors are more likely to take the service. People who have lower account value with smaller portfolio are more likely to take the service. And so this is the first important aspect. So we would expect, for example, that young investor would be more likely to take up the service. But a surprising fact is that those who have low portfolio value, those who have been typically don't have access to human advice, are also more likely to take the service. A second important question, of course, the mention is which type of change the robo is likely to induce, and more specifically, conditional. So if the robo proposes a larger change to your portfolio, are you likely to accept the robo? Are you more likely to accept the robo or not? So we see this in column 3, and we construct both for robo takers and for robo curious the distance in terms of equity exposure that the robo proposes relative to the current equity exposure of the investor. And we observe that the larger is this distance, the larger is the probability to subscribe the service. In other words, investors are more likely to value, let's say, this service if the robo is proposing a larger change in their portfolio. And you see in column 4 that this change is valued even more when it's about increasing the exposure to risk. Okay, and we think this is interesting because this is typically not what happens with human advisor. Okay, with human advisor, what we know, what we observe, is that human advisor are able to attract clients if they are pretty if they accommodate the client prior or the client current allocation. So if they propose very little changes to the client allocation, and that's in fact part of the problem with human financial advice. Okay? So to summarize the 2 key points here, the robo is able to attract investors with smaller portfolio, and investors are willing to accept robo allocation which are far away from their current allocation, and this is different from human interaction. So in terms of how investors change their behavior after having taken up the robo, we have evidence that investors increase their attention after having taken up the robo. And you can measure attention in various ways, in the numbers of connection to the platform, the number of minutes spent on the platform, the number of pages which have been visited by the investor. All these measures go up. So overall, investors increase their attention once they have the robo, and the effect is pretty persistent. Okay, the effect is there also. So there is a mechanical effect, of course, at the time in which you subscribe to the robo, but the effect persists even beyond the time in which you subscribe to the robo.
Milo, I see that there are many slides left. So do you think you can like finish in about 2 or 3 minutes?
Yes.
Sorry for that.
Yeah, no problem. I plan to go fast on the findings, and then you tell me which one you find it interesting or not. But so increased attention is associated to increased trading activities, and importantly for the asset manager, but also importantly for us, it's associated with an increase of inflow. The amount of money that people are willing to put in the plan. It's also associated with a larger exposure to risk. So people, after having taken up the robo, increase their equity share. So they increase their amount of equity that they hold, and they decrease the amount of bond and money market fund that they hold. And we can see this also exploiting, as I was saying before, the knowledge, the exact knowledge that we have about the robo. The robo is creating a profile, and the profile then has different threshold, and depending on what side of the threshold you are allocated to, the robo will give you different recommendation. So we can compare people who are just at the left and just at the right of the threshold. These are pretty similar people, and because of this algorithm, the robo is giving different recommendation, and we see that those who are just at the right of the threshold end up with larger exposure to risk. Okay. Important fact is the fact that people change their choices over time. And this is an example of the email I was referring to before, in which if the distance between the current allocation and the target allocation is too large, you get this type of email, which tells you that the distance is large, and asks you to connect to the website and to rebalance their portfolio. Okay, so we can see that those who so we are asking whether people respond to those alerts. This is also an indirect way to look at whether people still trust the robo after having experienced the service and after having possibly experienced some market shock. And more generally, we know that there is a big problem for individual investor is in the way in which they rebalance their portfolio, and this is typically costly. This dynamic mistake that they make are typically costly for them. So we observe that those who receive the alert are indeed showing a smaller distance between the current allocation and the target allocation. And we show that this is really driven by the alert. So again, we know the way in which the robo function. We know that there are thresholds here across based on the distance in the equity share. And we can do the same thing and see people who are just at the right and just at the left of the threshold. Those those who receive the alert and not who receive the alert, and those who receive the alert are then more likely to be closer to the target. This and let me then conclude with the last couple of findings. These rebalancing behavior are associated to larger returns. We observe that people experience larger returns. So we estimate the total effect to be about 5% in annual terms. Part of this is driven by larger exposure to risk. So if you control for risk, you get estimates between 3 and 4%. But importantly, and I think most interesting, about 2/3 of this effect is driven by the difference in rebalancing behavior. Okay, so we estimate that a large part of this effect is due to the fact that people change their rebalancing behavior and stay closer to the target. Last finding is all these effects of increased equity exposure and increased return are even larger for those who had lower equity exposure to start with, lower returns to start with. So in a sense, having access to the robo is decreasing the differences across investors, both in the returns and the equity exposure. And they're also larger for investors which are smaller in the sense of having lower income and lower wealth. Okay, so this is suggesting that, at least in this case, the robo could be an effective tool for financial inclusion. I will stop here. There are a lot of things that, so I think our main finding is that the robo is able to reach investors which have been traditionally not covered by wealth management service. It tends to increase attention, risk-taking, and risk-adjusted returns. And a lot of these effects are on the dynamic part. There are a lot of questions that we would like to discuss further. One is what drives this mechanism of increased trust in the robo, and second, what are the long-term effects of the robo, and in particular, what are the effects when in bad times, okay, when the market is not doing so well. I think I'm clearly out of time, so I'm sorry about that, and I thank you for your.
Thanks, Milo. It's a really fascinating and probably a unique study of a kind. Olivier, you had a question?
Yeah, I guess it was mostly a clarification question, and I apologize if I missed it. Did people select to interact with a robot or a human, or were they randomized in each group?
Yes, so no, thanks for the question. I should have made this clear. People select to whether to interact with the robot or not, and of course this is a major concern for the interpretation of our findings, and we do a lot of robustness checks, and also we try to, for example, instrument the probability to take up the robo with the fraction of people who have taken up the robo in the firm, with the idea that maybe there are spillovers within the firm. You hear from your colleagues about the service and so on. So we are aware of that, and we try to address this. And the second point, the counterfactual, is that you don't receive any advice. Okay, so here the counterfactual is robo or you are on your own. Okay, and in fact that was the main interest from the asset manager viewpoint, was able to reach investor at low cost. Okay, the investor with no advice, the asset manager was asked to devise something to reach them at low cost.
So I had two follow-up questions. I mean, one you already answered, which is, how do you control for selection? And the other one is, are you able to understand why people choose a robot versus a human? I mean, do you get some information about that?
No, so in fact, we don't have information on their. So when I do comparison between robo and human, the human part is based on other studies. Okay, we don't have direct information on whether those investors have access to a human advisor. I mean, no one of them has direct access to a human advisor on this plan, but it could have, of course, access to human advisor for other investment product that investor has. the idea is still that we have a lot of small investors, which are typically not covered in this type of study. Typically, this type of study look at clients of a brokerage house, let's say, which are a bit more wealthy than our clients. So many of us, we suspect, even though we don't have direct knowledge, that they don't have access at all to human advisor.
Okay, thank you.
Thank you. We have another question by Nia. I'm sorry, Nia, I forgot how to pronounce correctly your name.
It's Neve. Thanks, Nicola. Just a very quick question. Were all of the investors already invested and they were using the robo-advice to switch their allocations, or were there any investors that were completely new to the savings scheme and were using the robo-advice for the first time?
Yeah, so thanks for the question. Everybody was already in the scheme, that's helpful for us because we can observe their behavior, before and after the adoption to the robo. Even though the adoption, as it was mentioned, is it's choice, so it's endogenous. But for all of them, we observe what they were doing before. Okay. And the way in which you are enrolled is not your choice. It's your employer who decides, give you some money, and then you have to decide how to allocate.
Thank you.
Okay, so I think we are done for this workshop. So let me thanks again Valérie. I don't know if she's here yet, but she was really instrumental in organizing this workshop. And together with Stefan, I guess we thank all the participants, presenters, and audience. Stefan, you want to conclude?
No, I don't. I want to add nothing because your conclusion was perfect. I would like to thank everyone, especially Valérie for the organization, but also the participants, because we offered, I think, a large panorama of what we are doing in Toulouse. So I think that now we need maybe more feedback by SCORE practitioners or SCORE teams, but it's another part of the day. So again, I am very happy. I hope that we could have some other internal workshops, but maybe not online. So I insist on this, but I am fed up to be stuck in the tunnel. so as you know, I will be very happy to see friends, and I am like Sebastian. I like to share and to have pleasure with people. So I want to share. So it's very embarrassing to be online for me. So once again, thank you to all.
I will add also some words. And perhaps I don't know if Bruno would like also to add some words. Perhaps just firstly, thank you very much. It was highly interesting. It's not that because we didn't ask so much question, even if we had some questions, that we have nothing to ask. I think perhaps it would be interesting if you can share your presentation, and of course, as you have been registering and the fuel seminar, it could be also interesting to share the videos so that we can come back to the videos and some element of comments. Maybe we could also send you back some further more technical questions. But I would like, it's so rich as information and as area of research, and how much it can provide even to businesses, that I would really thank you very much for that presentation. I was impressed. Maybe Bruno, do you want to add some point on your side?
Philippe, not much to add to your point. That was very interesting. A lot of different topics. So and also we are a bit late, so I don't want to have this lasting too long, but super interesting. So thank you very much, Stefan and Nicolas, for the organization.